Market volatility is starting to spike ahead of what could easily become the busiest week of trade this year. We have massive tech earnings from Apple to Amazon, Microsoft to Meta, and many more, as well as a highly anticipated labor report that the Fed will be watching closely. So welcome to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we have a red hammer-esque style candle, where sure, the buyers did step up in the lower wick of the bar to form it, but they were only able to push price back in the upward direction towards about half back of the weekly range, never mind a recapture of the opening print, or even a close in the upper third of the weekly range. So, generally speaking, weekly structure seems a bit more mixed to me, maybe a slight bearish edge. If we're thinking about location on the bar-to-bar count, we do see a lower high, as well as a lower low, slightly more bearish. But what I do want to call out is that the weekly close is inside of the previous week's range. A more bearish close would have been under the previous week's range. So I would probably argue on the bar-to-bar count, we definitely have a small bearish edge, but generally speaking, what's the trend here? We have lows, higher lows, soft higher lows, and this could easily be a higher low. Generally speaking, on the weekly time frame chart, we've recalled that this is a pullback from the highest high in the trend count. If we do see a move to completely retest the weekly breakout level, that is fine from a weekly higher low perspective, noting that we would have lows, once again higher lows, and these soft higher lows would just be confirmed as firm higher lows if we could support above this level and make a rotation in the upward direction. The reason we're still intent on this is because if you take out a Fibonacci from this pullback low to the all-time high, generally speaking, the 38.2 is within striking distance of that weekly breakout level. And if you come in here with the anchored VWAP from this exact pullback low, you're getting decent confluence around this area. So it makes sense that although yes, on the bar-to-bar count, there might be a small bearish edge, on the weekly time frame, it's really not bearish. I would not call this a trend change or the threat of a trend change on the weekly time frame. We can confirm this as well with, of course, our volume profile. Let me just knock this down to about a 6-month chart will be fine, and we'll zoom in. And the point I'm trying to make here is that generally speaking, this high volume node is exactly where we've closed, and the higher volume node underneath it is exactly where the lower wick started to find support, which as we'll see right now actually, let's take it down to the daily time frame chart, is exactly where we got the pullback to, which is the key daily higher low. That level has not changed. We'll talk about the line in the sand here in just a moment, but we should begin, as always, with the weekly expected move. So here is the weekly expected move. The first thing I would point out about it is that it's massively expanded from last week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. The upper bound is still implying a new higher high in the trend count and an all-time high as well. That's 589.76 if contained. And if we're contained by the lower bound, the number's at 568.38, implying a violation of the daily higher low line in the sand. So I'm not too fond of that. I would really argue that the expected move this week is a little bit more neutral than it is leaning one way or another, bullish or bearish for that matter. If we're thinking about the trend count, we know that these were higher lows, and it's very possible that the Wednesday liquidation break in the downward direction could have caused or could have set the next daily higher low in the trend count. Recall that we are pulling back from the highest high in the trend count. This is the first major pullback that we've seen. We're all set from that perspective. Wednesday's structure is really nice because the lower wick indicates a strong response from the buyers at what was once previous quadruple top resistance, 1, 2, 3, 4 back here, started to act as a little bit of support on the inside bar. That was a Thursday session before the Friday breakout, Monday gap up, we recall. It was beautiful support off of that area. Now, let's play this out. On Thursday's session, we just printed an inside bar. On Friday, the market actually gapped up over the inside bar high, and as well as breaking intraday the high of the Wednesday session. So again, we'll put ourselves in the shoes of buyers based on this 3-bar structure we're analyzing right here. Did the buyers really make that much progress? I think the answer is not as much as we would have hoped for, right? In a more bullish market environment, this would have either been a gap and go, holding the Friday morning gains, or some kind of gap fill reversal that supported over the inside bar high and had closed over this 579.75 level. We did not get that here out of the market on Friday. So it's very difficult to say that the market is outright bearish on the daily time frame chart, but I would certainly argue that it's not bullish per se. A bullish close would have been inside of this box, causing some sort of look below and fail, supporting for a daily higher low, and then trying to make a rotation in the upward direction and potentially threatening blue sky territories into some upcoming trading sessions. That's not the case with what we had on Friday. One bullish indication we can talk about, though, is at least coming back to our daily 20 SMA. We've been talking about this, right? You recall that we had talked about consolidation through time, letting the 20 SMA catch up, and then using that as a launch point. Well, in this particular example, instead of letting the 20 SMA catch up to price absolutely broke down, caught up to the 20 SMA, retested it, and we were holding above. We still closed above that 20 SMA, even with the more concerning candle from the Friday session. So once again, I don't necessarily think that the bears are totally dominating the daily time frame chart. It seems like a mild pullback until proven otherwise. I would certainly start to change my tone on the daily chart if we started seeing daily closes underneath this line in the sand at 574.40. We're just not there yet. To be bullish here, of course, just acceptance inside of the range over 579.75 would be more constructive. I do want to bring up this alternate view one more time here as we're thinking about the overall structure of the S&P 500. A lot of people are talking about it. You're going to see this chart floating around on social media. If the rising wedge breaks, yes, it could trigger a bearish move. I would really say break the trend line and get underneath that 574.40 mark, and then I would have some deeper concerns about the daily time frame chart. If we just quickly flip back on over to the other drawing set, you would notice that your weekly line in the sand for that higher low is down here at 566, and that would be slight alignment with our daily 50 SMA on a stronger pullback. We really haven't interacted with the daily 50 SMA in quite some time, about a month and a half at this point, so it wouldn't be unreasonable that if we did come down here, there is some sort of support off of the daily 50 on the first test. I want to be very clear here. The first test is the best test of your major moving averages that many folks watch. Of course, the threat, and we're getting a little bit esoteric here, the threat would then be that any lower high that's set, now what did I just draw, right? You have left, head, right shoulder. Sure, we can call it a bearish reversal pattern when and if this happens, but this is not a primary outcome. I want us to be thinking about the weekly time frame chart, the uptrend that we just explored, the possibility for weekly higher lows, the fact that this is still a daily higher low until proven otherwise. This is kind of a tricky spot in the market. This is more bullish and this is more bearish underneath that 574.40. The bullish spot is over 579.75. Let's take this on down to an hourly time frame chart. We'll start to get even more granular with the price action. So as we can see on Friday morning session, I really think we want to read into this. Friday morning was beautiful because we had the inside bar here, right? This is sort of what the daily looked like. There's your daily inside bar. This, of course, is the Wednesday session looking something like that. Friday opens on a gap up right at the high of day from Wednesday, rallies out of the gates, and then has an opportunity to potentially provide a higher low over this inflection point from back here, which we know on the ES futures, if you tune into the morning show, right, we had talked about 58.92 until we were blue in the face. That's exactly this level right here. We've been watching that basically all week. So the fact that there was no higher low intraday over that level in the S&P 500 cash, it's 582.75, does strike me as slightly alarming. So that's like slight alarm number one. Slight alarm number two is the fact that we come into the previous day's high and we didn't get any semblance of support there. Notice that, yes, this hourly bar is technically a hammer with a longer lower wick, and yes, buyers did try to step up, but where was the previous bar's close? I mean, the lower wick should have been here. If this was going to be a strong response from the buyers, right, it should have looked like an hourly bar like this, with the wick respecting that gap fill reversal, closing up here, potentially going on to make a stronger move in the upward direction. So, not everything is fine and dandy here, even on the hourly time frame chart when we're evaluating what the response of the buyers was off of this key level. It really wasn't as strong as what you would have ideally liked to see in a picture-perfect market in the upward direction. So what does it mean, Matt, for the pathing going forward into the coming weeks worth of trade? Now, of course, a lot of the technicals may be invalidated as we start getting earnings if there are large gap up, gap downs from some of these heavy-hitting tech names. So keep that in mind. But from a pure play technical analysis perspective, anything that's consolidating in here, I would probably be open-minded to bearish trades trades, not longer term investment ideas or any big counter trend moves to the weekly or daily, but from point A to point B. This would be underneath 577.15, trades back down into the daily line in the sand at 574.40. If we get here, I'm still keeping an open mind to the potential for reversals that look like this. Any stronger hourly or even daily lower high that is then set underneath 579.75, this opens the door for a break on what I would say would just be the third test at that point in time, right? Anything that's underneath that level or another test after a daily lower high starts to become more concerning. I would really argue on the daily chart, we do not have a lower high yet. This is all still a balance range up here. So that's if we're sub 579.75 earlier on in the week. Bearish consolidation. Maybe this is a quick scalp to the downside, looking for a response again off of 574.40. If we get a bullish open on Monday over 579.75, something that looks like this, then great. The bulls technically still have an edge, remembering back to the weekly and daily trends, which are technically up. This is a daily higher low until proven otherwise, which of course means that you have to break through it. So an open in here sets now the opportunity for another hourly higher low. If you're thinking about the hourly trend count, you have lows, higher lows, literally on the bar-to-bar count. An open and hold over 579.75, in my view, would probably start a rotation back up towards the top end of the range. You might want to respect this 582.75 just a little bit there, but a hold over 579.75 has to be more bullish than bearish in the grand scheme of things. We could start thinking about how this is really not a good excess high in the market. All-time highs are typically not set like this. You want to see an excess move that then comes back down into range. So it's not technically speaking a poor high or a mechanical high at the all-time high yet, but it just doesn't strike me as being like the way the all-time high should be set. If you've seen previous all-time highs get set, we're talking about drawdowns in 2022 and, even before that, obviously, you do get some sort of excess high. The auction does not seem complete up here towards these highs. So we'll see. Obviously, Tesla earnings are off to a good start. We'll talk about that when we get to the chart. So Tesla and generally earnings season could be a positive influence. We will see. I'm not going to make bets based on that, but again, our key technical level here is 579.75. All right, enough about that. Let's talk about the intraday anchored view apps. Any confluence? Absolutely. It's just going on to reinforce that this is such a key level for our charts as we move forward. Above, have to lean on the bullish edge, have to be thinking about the uptrends that are underpinning the weekly and daily. Below, we can start to have some of those targets for, once again, look at that confluence. It's not going to be there forever, but that daily line in the stand is looking pretty darn good. We'll even zoom out a little bit here just to get the origin of this rally, the low of that mark here, up to the all-time high. You are getting that 38.2 right at our key level, 579.75. I don't know how much more clear this could be in terms of confluence and just the way that we need to respect that level either above or below to lean on stronger bull or bear outcomes here. Let's take a quick glance at the market internals, what's going on from this perspective. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. One thing I do want to point out is that the volume flows were technically out on the week, but were they substantial? The key answer there is no. If you look at this read down here, it's only 504 million. Typically, we're looking for 600 million plus or minus as a threshold to call something substantial. No individual day this week was substantial either underneath negative 300 million, even on that liquidation break from the Wednesday session back here. If we're thinking about the advanced decline line through a similar lens, right, where any days aggressively just pinned lower in trend lower zone, which is this zone down here, the only day that got close was actually Monday, where the market was more so sideways, I would argue, than anything else. And on the Wednesday session, you were lower in the overall range, but not just trending lower all day. If you look at the index score into the afternoon on the Friday session when that big reversal took place, even with a move so substantially underneath the opening print, this could not build into the afternoon down towards negative 20 or negative 15. So I'm carrying that forward as a more mild data point for the S&P 500 in particular. If we're thinking about the cumulative builds, again, we have to give credit where credit is due. There was some selling pressure, but once again, is anything here like, oh my goodness, the market's going to zero style selling pressure? To me, the answer is no. I'm really not seeing it in the underpinnings, and primarily that's coming from the volume flows being more lackluster than anything else, and the index score here intraday on Friday, even with that wicked reversal back to the downside, not really building into negative territory. If we take a look at the market profile for the ES, if you're not familiar with the profile, check out the video tutorial in the top right-hand corner. There's a couple of nuances here to pick up on. Number one, is just going to be the repair of many of these poor areas in the market. So that's all set. Those areas have been resolved, if you will. We still have really strong looking volume tapers here off of J period lows on Wednesday, F period lows on the Thursday session, and even J period again on Friday does strike me as a decent volume taper. Now, we do need to talk about the nuance of the double distribution. So you have upper distribution here on Friday and lower distribution here on Friday. Of course, the point of control did end up flipping lower. If you were watching about 30 minutes before the bell, into power hour there, the point of control was still up here. That, of course, did flip lower with price into the close, and that does strike me as a slightly more nuanced bearish data point that we will want to carry forward into the beginning stages of this upcoming week. What I would focus mostly on is honestly just the way that this confluence right here sets up with the double distribution, right? So the lower distribution's high at 58.62 in the ES futures. If you could get above that and rotate through the singles getting acceptance in the upper distribution, that's where I think the bulls have their edge back. If you're just consolidating in the lower distribution, unfortunately, you're sort of stuck between that rock and a hard place. Remembering, again, just from a visual perspective, understand that your single prints right here pretty much delineate the top of Thursday's session to maybe your loose confluences, right? The top of the Wednesday session. Let's go back on over, right, to the price charts over here so we could talk about these key levels. Your single prints are basically this box right here on the spider's cash, right? If you can get acceptance in the single prints and push into the upper distribution, more bullish than bearish. If you're accepting in the lower distribution, slightly more bearish than bullish. And of course, that unfolds or offers, I should say, the exact trades that we've already described. So the market profile makes sense here with the way H period single prints divided the upper from the lower. It's aligning with a key technical level here on the candle charts as well. Of course, the anchored VWAPs and the Fibonacci 38.2 as well. So we're pretty clear on the S&P 500. I think that it is cautiously bullish, getting more bullish if we can accept above here, looking for that rotation. This area is sort of like no man's land, and I will absolutely be willing to raise my hand, change my tone if we start breaking down underneath 574.40. I would absolutely start thinking about the stronger weekly pullback into that line in the sand we've described at 566. Daily 50 SMA as well that we were talking about earlier. With that, we will move along to our QQQ nasty NASDAQ cash ETF. What do we see here on the weekly time frame chart? Let's clean this up, and we will see what we can see. So in terms of structure and location, as we typically evaluate, what do we see? We've got more of a doji-esque style bar out of the NASDAQ versus the S&P 500, a longer upper wick that's formed here. And you'll, of course, also notice that we have a green-bodied bar instead of red. So a little bit more indecisive, a little bit more of a battle, if you will, between sellers and buyers and sellers. And I would probably say that because it's got to be neutral. There's no way to spin this. Obviously you could call this a spinning top, so no pun intended. There's no way to spin this more bullish or more bearish than it is. Technically, it's an outside bar. Notice that the upper wick makes a bar-to-bar higher high, and the lower wick makes a bar-to-bar lower low. So in theory, as you breach a previous bar's low, maybe there should be some acceleration from the sellers. That, of course, did not take place. You could say the equal opposite over the previous week's high. No acceleration from the buyers. We close inside the midpoint of the previous week's range. We close over the opening print, so perhaps a mild bullish edge, but really, I don't want to stretch it any further than just neutral here based on really just weekly sideways consolidation more so than anything else. Adding in the context, though, that we have lows, higher lows, soft higher lows. These could also be soft higher lows, and this is all happening over the double bottom neckline, if you will, if you want to count this pattern as follows. It does strike me when we add that context in that, yeah, it's probably still leaning on the bull side of the market here, but cautious if we come back in for retests of this neckline. Because we haven't really had a firm resolution and strong weekly bars close up near the all-time high or through the all-time high, still have to be somewhat cautious of this neckline here on the weekly. We're not testing it yet, but it's something to carry forward. If we come in with the Fibonacci's from the low up to the most recent new high, 38.2 is beautiful confluence there. Roughly the 480 zone, right, is what we're looking at. If we come in here with the anchored VWAP weeklies, again, great confluence, that's still there. And we can just finish off everything on the weekly with the volume profile to take a nice easy look. What do we see in terms of this high volume node? It's continuing to act as support in the lower wick of last week's bar. So with that, we'll knock it on down to the daily time frame chart and see what's going on from this perspective. First things first, of course, weekly expected move. What do we see here? Still suggesting a new higher high in the trend count, actually a brand new all-time high as well. That's 507.28. And if we're contained by the lower lower bound, the number's 483.88, suggesting more of just kind of like equal lows. This might actually be slightly more bullish than bearish on the daily time frame chart, especially noting that the daily higher low line in the sand is around this area, whereas the S&P was suggesting that you could potentially go more meaningfully through the daily line in the sand higher low. The other thing we could call out here is that the NASDAQ is actually stronger slightly on the daily chart than the S&P 500. Why would I say something like that? Because I believe the catch-up trade is still very much so underway. We know that the NASDAQ has not made new all-time highs yet. The S&P has. But look at the daily bar from the Friday session and notice also that it did make a new pivot high. So let's keep it simple here. We'll start with trend and then structure. We've got lows, daily higher low from Wednesday's liquidation break, highs, higher highs, and technically an intraday higher high on that Friday session. So the trend is up and we're pulling back from the highest high in the count. We technically have some unfilled gap from that Friday gap up, which is different once again from the S&P 500. We're completely outside of and above the Thursday high. I would argue that a new daily higher low line in the sand could be formed right here. I'm still going to give this the benefit of the doubt and call it just consolidation in this box. But if you could see like a gap fill reversal, if you could see a hold here of the bottom end of this range, which is at 491.25, that would absolutely be way more bullish than bearish on the daily time frame chart, noting the continuation of the trend. And once again, the pullback is technically coming from the highest high in the count. So let's give some credit where credit is due to the sellers, a full-blown reversal of that Friday session, but not really enough to get acceleration to close the gap. So again, on the daily chart here, you might be seeing some signs of like slowdown or the lack of conviction in the upward direction. That could easily be just because of the uncertainty around earnings reports that are about to come out, the labor report that's about to come out. But generally speaking, there's nothing on the daily chart that is overly aggressive in the bearish direction. If we take a quick glance over at the 20 SMA here, just like we did the S&P 500, you overshot on that Wednesday with a close underneath, used it as support on Thursday, and you're still well above on Friday. So again, nothing inherently bearish, even from a moving average perspective. We could throw on the wedge, just like every other person online. Let's see how the wedge is treating us. How many wedge charts have you seen out there on social media? Let me know down below in the comment section. We added one to the lineup earlier on the Saturday session, but generally speaking, we're still well above the support trend line of the wedge. If it breaks down, could there be cause for concern? Yes. Where would I personally be concerned? You guys know this if you've been following the channel. I'm not really fond of support trend lines or any trend line really. I'd be more concerned if we were to get a break underneath Wednesday's low at 486. Underneath 486, I think you're starting to suggest more of a lower low in the trend count and the possibility of just, again, one of these very loose head and shoulders-esque style formations. Things would really get nasty underneath that 477. Recall on the weekly time frame chart, we had talked about how 480, roughly this kind of area right around in here, is the neckline of the double bottom, which is perhaps a little bit more obvious when drawn in from this perspective there. So again, concerns step in. Things start to get more dangerous if 486, is breached. I'm not seeing the argument yet. If earnings really send this thing for a slide, sure, we'll talk about it. Let's move on down to the hourly time frame chart and not take up too much time here. One of the things I want to point out is, again, in terms of relative strength on the NASDAQ, is just that this was such a key balance range that you had broken underneath. Let's put ourselves now in the shoes of a seller, right? We had talked about putting ourselves in the shoes of buyers on the S&P and how maybe Friday's close wasn't all that great, but let's do the opposite for the NASDAQ. We're sellers, right? We see this big breakdown on Wednesday. Great. We're jumping for joy. This is awesome. Thursday technically should represent an opportunity for a lower high to be set underneath the bottom end of this range. You're getting an hourly lower high. Did that take place? The answer is absolutely not. And again, there was an opportunity. Notice this third hourly bar's lower wick was well underneath 491.25. No lower high. We closed back above the level. Stronger sellers would have absolutely pushed price underneath that and stayed underneath that for a daily close. Didn't happen. Friday's gap up gets us over the top end of the range. We accelerate to make that new higher high as we just described on the daily chart. And if you're a seller, by this point, stops were probably over Wednesday's high, over the top end of this balance. So sellers are completely gone. You could call this a short squeeze. But even if sellers stepped in again at 499.50, sure, great location up here. But if we can hold price over 495.25, if this gap does not close all the way, what would that tell you generally speaking about the types of participants who are in control and feeling good about positions that were built in this consolidation back here? Probably buyers have the upper hand. So 495.25, partial gap close. Yes, I know the lower wicks in here. As long as we're over that, I think that the buyers have an opportunity for a massive higher low. Even if you went, like, let's stretch the argument, right? Gap fill reversal, something that looks like this, I would absolutely long the Brigade bolt here back over 495.25 if it were to take place, because you have lows, hourly higher lows, daily higher low, gap fill reversal, technical repair of structure. That would look beautiful. Let's come in here with the Fibonacci's from the bottom of the Wednesday move. Oops, if we could get a click. Thank you, Thinkorswim. To the top, you'll notice that that's about 50% retracement of the move higher there, so that makes sense. And 491.25 just acts as a key line in the sand because it is the 61.8. As we know, the more bars that you close under the 61.8, the higher the likelihood that you do see the 100% retracement. As of right now, you're over the 38.2. So on this catch-up trade, it's sort of in a weird and twisted way. Although the NASDAQ has not made weekly, new all-time highs, there's actually better relative strength here intraday out of the NASDAQ on that Friday gap up, failing to close it all the way. Let's quickly check in on the anchored VWAPs here. Beautiful consolidation, confluence and consolidation, really, of the anchored VWAPs at that 493 gap fill reversal. So if there is downside, this is absolutely a location where I would be looking for bullish outcomes, trying to buy that, or the first higher low Brigade bolt back over the level here. Targets 499.50. Cause for concern, as we talked about, might be on some sort of breach underneath 491.25. Bearish outcomes happen here for a retest of the daily line in the sand, 486, as we've already mentioned. Lower highs that are set under 491 after a test of this absolutely threaten the possibility for a daily trend reversal and what we were talking about earlier, the breakdown towards that 480, 477 zone, the weekly line in the sand, correct? So all set here on the nasty NASDAQ, leans more bullish than the S&P earlier in the week until proven otherwise given what's happened on this session. Let's quickly check in on the NASDAQ internals, see if this is reflective of the more bullish activity. And I think the answer is absolutely. I mean, volume flows are not even triple digits on the millions mark in there. Negative 71 million, so not even close. You had volume inflows on Thursday and the Friday session after the liquidation break from Wednesday. Yeah, you had 1 day of substantial volume outflows at negative 400 million, but it wasn't enough to really get follow through. And we just saw that in the sort of story we walked through on the hourly chart. Sellers did not really build off of this downside momentum. You were under trend lower zone here, and you faded from trend higher zone to the zero line, but that's really not all that, I wouldn't call it inherently bearish. It's kind of more mildly neutral, if anything, on the Friday session. And again, we'll give some credit, 100% reversal. Sure, sellers had something going on off the high of day, but generally speaking, the location probably still favors the bulls. If you think about the sort of cumulative tick down here, hardly getting negative into that Friday afternoon, even with that selling momentum off of the high. So I do think that the NASDAQ has some better strength than the S&P 500 in the short term. If we take a look at the NASDAQ market profile through this lens here, you're not even getting a double distribution on Friday. You have a poor high at the top of the move, B and C period, and you have decent excess in J period. The point of control, let's just make pretend, right, that this was a double distribution. Point of control is in the upper portion of the NASDAQ versus the lower, like the S&P 500, and it's well above the breakout level of the inside bar from Thursday, right? I mean, just clearly making progress in the upward direction. So NASDAQ has the relative strength baton right now. I think the sellers are either getting pinched out or the buyers are trying to maybe prepare for what could be around the corner with big tech earnings. Let's jump on over to the Rusty Russell and see what's going on with our final broad market ETF. Let's jump this up to a weekly time frame chart and, of course, a clean drawing set. Thank you guys for always sticking it out with me as I'm adjusting these charts in real time as we get ready. Here we go. Weekly chart, candle structure, and location. What do we see? So definitely, one of these things is not like the others. The other two were doji-esque, hammer-esque. The Russell is absolutely a large red-bodied bar that absolutely makes, on the bar-to-bar count, a lower high and a lower low with a meaningful close underneath the previous week's low. That, of course, is bearish. Now, is it bearish in the grand scheme of things, as you just saw with those yellow trend lines? No. I mean, technically speaking, you are still building lows, higher lows, higher lows. It's possible there's a nuanced higher low here, but the candle structure doesn't really give me all that much confidence. It would have been best if this weekly bar could have stayed, in a picture perfect world over what seemingly was a little bit of a breakout level from back over here. That's not the case. Before we move into the anchored VWAPs and fibs, I do want to look at the KRE. Just to show you that even regional banks, which are obviously very sensitive and sort of take into consideration interest rates and the big R word, recessionary themes. I mean, this pullback has taken place, but this even just went to the top end of its balance range, the weekly 200 SMA. It's not like KRE is underneath 53. And you can make similar claims about the XBI, This is still over its long-standing balance back here. Would it be better if it broke out of this range? Absolutely. We're not making that argument. But generally speaking, is it the end of the world just yet in some of these smaller cap indications? Not really. XRT would be another one we could at least explore. It'd be great if we could get a flat top breakout. Not there yet, but still over the key breakout level, right? This underneath us is still long-standing demand that's broken out. The longer we can stay above, the more meaningful it becomes. Hopefully, the next one is just a break over the flat top. But anyways, back on over to our IWM small caps, let's quickly check in on a couple of Fibonacci perspectives. Remember that we've been using the distance from the top to the bottom of this range over here. So from here up to the top, I'm just hovering my cursor looking off to the left. We're still over the Fibonacci 38.2. So we're doing okay from that perspective, not the end of the world. If we come in here with the anchored VWAPs, what else can we see? This is still acting as beautiful confluence of support. Once again, not the end of the world. It's just really not the most convincing argument that with a weekly open over this level, again, a more bullish chart simply would have been, let's just keep it very simple, something that looked like this into the future. We're obviously not getting that. It's not the end of the world, but it's not nearly as bullish of an opportunity, or at least capitalizing on that opportunity as it could have potentially been. Let's drop it on down to the daily time frame chart and see what else we can learn. One thing I do want to call out, as we're just on the first topic of expected moves, is just that last week's expected move here in the Russell was this. We hit the lower bound in the first hour of Monday's trading session, and there was no counter trend move in the upward direction at all. Yes, you're getting a little bit of lower wicking happening here at the daily 50 SMA, a little bit here off the top end of the balance range on Thursday, but no real love from a mispricing perspective of the options market, getting a counter trend move back into the weekly expected move. So that's pretty detrimental, and once again, would sort of seem more like the failed continuation of a move in the upward direction and mispriced egregiously by the options market. If we're thinking about this week's expected move, the upper bound is 224.52, lower bound 213.26. There's really nothing more on the daily chart to say other than, hey, this is probably a bear flag we want to watch out for. The more price acceptance we get underneath this daily high or low line in the sand, 219.25, the more likely it is that you get this rotation. This is the weekly line in the sand at 215. If that goes, just look left, thin structure retracement, you're probably talking about a pretty substantial headwind over in the S&P 500. So we'll dial back expectations if small caps really start to get beat up underneath 215. That to me is going to be the big trigger this week to see if this slide continues to the downside or if we just sort of consolidate out in here. Generally speaking, small caps really haven't done much in this overall box for a very long time now. So the best trades as you're thinking about small caps as a general theme for the S&P 500 will simply be new pivot high or new pivot low. That'll be way more informative than just chopping around inside of here, right? Let's drop it on down to the hourly time frame chart, where you can see again, not the first hourly bar of the Monday session, the second hourly bar. So my apologies, 2 hours into the week, and we've already hit the lower edge of the weekly expected move, just insane. But just notice how all of this is, bearish consolidation. One thing that we talked about in the NASDAQ in particular is that the sellers failed to produce lower highs, right? Whereas on the IWM small caps, the sellers absolutely, continuously produced lower highs here. There's much more of a meaningful hourly downtrend in place. There's clearly lows, lower lows, lower lows. There's a lot of work that the buyers have to do if they're going to turn this ship around. So some general locations that I would be thinking about, anything in here is just neutral consolidation. This helps the bull case on Brigade bolts over 221.75. This helps the bear case getting us down to that line in the sand at 215 lower highs underneath 219.25. Keep it simple here in the IWM. No need to overcomplicate this little multi-day range that we've formed. Here's your intraday anchored VWAPs barreling down on top of us, so we're underneath the entire cluster, probably leans more bearish than bullish, and we can come in from this rally from the bottom up to the top. Lo and behold, notice the multiple closes, 1 and 2, technically over here on Wednesday, underneath the 61.8. Just recall, the more times you close daily or even hourly bars beneath that 61.8, the higher the likelihood that you do get a 100% retracement, in this case, back down towards that 215 line in the sand. So, small caps, probably an issue worth watching for into the coming weeks worth of trade. Let's quickly look at our Rusty Russell market internals, see what's going on from this perspective. You definitely had some volume outflows on the week. This is not the substantial number. You're looking for 250 million on the Rusty Russell, so that's not quite there. You are getting some bearish builds out of the tick, mixed on that Friday session in particular. On the advanced decline line, you probably close a little bit more firmly in negative territory here on the Russell than you did in the S&P as well as the NASDAQ. So again, more of a threat here as a headwind to the S&P 500, absolutely coming from the Russell at this point. As we take a look at the market profile for the Russell, Value was completely slammed lower on that Monday liquidation break to the downside. Tuesday, value actually continues to progress lower. There is no counter trend move in the upward direction. On Wednesday's session, value progresses lower. Thursday is kind of inside value here. It really didn't make a move in the upward direction. And then notice this nail in the coffin. Point of control moves lower than here and also lower than here on Friday. There is technically a poor high in B and C period, just like what we saw on the NASDAQ, so carry that forward, but it really doesn't strike me as a high probability trade that we should be aiming for early on in the week. If we come up and test this, yes, it's nice to know, but it's really not going to inform the decisions here. Notice at the point of control, we do have a single H, a couple prints here for H period separating an upper and lower distribution, and of course, point of control did migrate to the lower distribution. I think it just reinforces everything we've talked about. The bears do have the edge here in small caps in particular. Let's jump on over to our sector analysis from the S&P 500, beginning with the weekly performance, starting in our list over here. Who was leading, who was losing, where was the weight? Leading the pack is the XLY, of course, with Tesla. Big earnings gap up there on the Wednesday into Thursday session. We'll talk about it. Up 87 basis points on the week. Semiconductors also performing pretty well relative to everything else, up 78 basis points in the tech sector, also up 4 basis points. So as I'm thinking about, is this the start of an Armageddon-style sell-off, sell everything S&P to zero? Absolutely not. It still looks like there's some sort of rotation taking place right now. And when the market gets into bear mode where, oh my goodness, we have weekly downtrend, daily downtrend, hourly downtrend, short everything, there's going to be no rotation. There's no safe place to hide when the market falls into those types of times. So seeing this rotation here does strike me as, once again, supporting the fact that on the weekly, perhaps, this is still just a mild pullback until proven otherwise. As we're thinking about the bottom end of the barrel, it's the materials sector, extremely lightweight, industrial sector, 8% roughly, and then healthcare down 2.71%. Third heaviest weight sector by market cap, but also still D for defensive. Let's check in on the actual charts themselves, see exactly what's going on here. Love the fact that the XLY was able to get up and over the top end of this balance range here. It did, technically speaking, produce a higher high in this trend count on that Friday session. But yes, there are a number of these concerning daily bars from Friday's session that closed out as an inverted hammer. The main thing we want to be thinking about here is just, is there an opportunity to consolidate over a key level and hold up for a higher low? The answer is yes, looking at 198.50. As long as we're above that this week, kind of good to go looking for upside. Obviously, Amazon earnings will have a big impact on the XLY next. SMH Semiconductors, AMD is reporting earnings this week as well. So you're going to get some volatility here. Not overly fond of this chart, and it's primarily coming from the fact that on the ASML day, way back over here, there's no attempt to get back over this level, right? 255.70. I mean, maybe you tried it a little bit on that Friday session, but again, those nasty daily bars are starting to pop up more places than not. We've got a bearish inverted hammer, possibly suggesting the beginning stages of a head and shoulders. Now, I would not throw in the towel here and say that, oh my goodness, we're dealing with a bearish reversal until we start getting price acceptance underneath, not just the neckline. You guys know me with the horizontal levels. It's more so 245. If we're under 245, breaking the 50 SMA, yeah, I would start to be a little bit more concerned about either a stagnation event here out of semiconductors, or even worse, would just be a rotation back down towards these lows. I personally don't think that that's going to be the case. This is a little bit of personal, non-objective. This is a little bit more subjective interpretation. If I'm thinking about semiconductors, AI, and just that technology space in general, I don't think there's a reason for semiconductors to dramatically flip into a long-standing weekly downtrend. I think that there's going to continue to be a pushed valuation in the upward direction. So again, a personal take there. The chart says that we're neutral until proven otherwise. And here, this of course gets more bullish for the gap close above. And I'll change my tone from a trading perspective. Like, you bet your bottom dollar, I'm not going to hold on to that like subjective take. If the chart clearly flips into a downtrend, I'll be willing to trade short semiconductors. Don't you worry about that. But that's just my general feeling. The XLK, market doesn't care about your feelings, right? That's the classic saying. What do we see out of the technology sector? This looks far better than the SMH Semiconductors, noting that we have a balance range here. Yes, a nasty daily Friday bar, that's fine. But as long as we're over 228.15, it just strikes me as bullish consolidation over the neckline of the massive double bottom that we've been dealing with, right? You could even just consider it an ascending triangle, whatever you want to call these things, it doesn't matter. But as long as you're over the apex of, again, pick your pattern, you've got to be more bullish than bearish. So if we're over this level, great. It's bullish consolidation until proven otherwise, aiming for the all-time all-time high, which would be a huge supporting piece of evidence for the NASDAQ itself. So watching that, 228.15 out of the XLK. Materials, extremely lightweight. Yes, it's a picture-perfect M pattern. Call it a double top, whatever. Doesn't really trigger anything until you're getting lower high acceptance below 93.60. Lightest weight sector, not going to move the needle. As we take a look at industrials, 8%. Yeah, a little bit of a close underneath this breakout point here. I'd love this to be just an overshoot and some sort of rotation back to the upside. That would be my preference here to maintain the overall strong uptrend that we're in, but I would be willing to just sort of dial things back if industrials start to slip a little bit and stagnate down here. I would start to lean more bullish in the market if we do get this rotation, let's say like a look below and fail of the 135.70 level. Next up, healthcare. This is the third heaviest weight sector by market cap. Let's look into it just a little bit here. Key level approaching daily 200 SMA key zone from back here with all of these price interactions. Resistance, about 6 times here before the break and hold above. Overshoot, but ultimately acted as the launch pad for the rally. Really interested to see some response from the buyers at 148. If that's the case, great. I would sort of lean into that as being bullish tailwind for the S&P 500. If it goes right through like a hot knife through butter, I think it starts to say something a little bit more meaningful about the market, suggesting that even a defensive and heavyweight sector is not getting any love at a key technical area. This is a very important weekly level, weekly zone, if you will, between 147.25 and 148. So really watching that. I would say even if it does rally, you could say this is still a bearish headwind, noting the daily downtrend here with highs acting as a double top, lower high here, lower lows, lower lows, lower lows. So it's very reasonable that this is just a counter trend move until proven otherwise, but really from that weekly high time frame perspective, 148 is a zone, very important out of this sector. XLU, what do we see? A little bit of a pullback, most bond-like sector, still hanging out near the all-time highs, improper end of the auction up here. Strikes me that it could easily get just higher low consolidation and try again as we continue to progress here. Not the end of the world. Lightweight sector, D for defensive. As we look at financials, a little bit concerned with the gap up and now obviously bearish engulfing bar from Friday's session. The gap up over the 3 highs here should have is a hypothetical if statement, right? So not saying that this needed to be the outcome, but if you're a bull, you want to see a gap fill reversal stay over the 3-day range, rotate to the all-time high, and possibly look for new highs. The fact that it closed underneath and we just have a thin structure here from the earnings rally seems reasonable to me that there might be a pullback to retest the breakout point at 45.75. Second heaviest weighted sector for the S&P might spell some trouble if that pullback does end up taking place. XLP consumer staples. Lower under here. This is D for defensive. It's also a lighter weight sector, so not as concerned with this breakdown. Absolutely in a daily downtrend, so make note of that. This is starting to shift here. Energy sector, keep in mind that there are some geopolitical tensions that are sort of being reignited. That's not meant to be a pun, possibly poor word selection on my part, but generally expecting crude to move higher on Monday morning if you've been watching the news, so I wouldn't be shocked to see a gap close overhead. I mean, this is what happened last time. There was some geopolitical unrest and some attacks taking place, so do we go back to 94.25 perhaps? Just watching out for that. If you take a look at crude, it's not really going to show any response. I think this happened too late in the day on Friday, but I wouldn't be shocked to see crude, back up here trading towards 76, 75 bucks a barrel on the strikes that are taking place. So just keep that in mind for energy. Let's move along to bonds are getting just absolutely annihilated. We know that the 10-year is moving in the upward direction aggressively. Investors demanding a higher yield here, pressuring bonds to the downside. So not really a shocker, but the amount of give back that's taken place, I do think is meaningful to make note of. This is no longer just like, okay, anybody who's long from down here was profit taking into these highs and sort of seeing consolidation around 98. This is more aggressive selling, I would say, of bonds with the expectation, once again, that there's really investors are demanding a higher yield, and you'll see this on the bond chart in just a moment when we sort of compare long versus short end of the curve. Here's the real estate sector moving to the downside as rates continue to sort of remain elevated. Not a shocker there. Lightweight for the S&P, not going to move the needle. Here's the XLC, and again, keep in mind earnings here is going to be your Google this week. XLC Google is reporting, I think, on Alphabet's on Tuesday after the close. We'll take a look in a moment. But failure at the all-time high is one thing to make note of. So again, not much of a fan of trend lines, but you could do something like this and say if it breaks, probably looking for the stronger retest of 87.85. For me, I just use the horizontal level here at 89.65. You guys know us, round numbers only up in the penthouse. There you have it. breakdown, Brigade Bolt probably causes some bearish pressure intraday, intra-week for the S&P, but probably not enough to throw in the towel and say, oh my goodness, it's the end of the world. So the theme of the sectors is that most things still look okay. There's some stagnation, but most things still look okay. There's really not a bearish development at the sector structure level. If we look at the ratio grid, if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. We still see the technology sector trying to curl in the upward direction over a pretty flat 50 SMA. I'd call this neutral. If we look at financials, probably trying to find a higher low over an upward sloping 50 SMA. That still strikes me as being bullish. If we look at XLV, which is D for defensive, probably more neutral, falling off of a cliff, third heaviest weight sector. We don't want it completely underperforming. As we look at the XLY, strong recovery on the Tesla earnings, of course, so I like the fact that it's trying to hold up for a higher low generally from here, here, and here. Yes, it's got some work to unwind what happened in this segment, but let's even if we just put this as neutral, it's very difficult to look at these four and say, oh my goodness, all of these are in aggressive downtrends. It's got to be risk off. We're just not there, right? If you look at the risk off sectors, I mean, consumer staples are underperforming, utilities even starting to pull back here a little bit, energy, not really a cause for concern. Real estate, hard assets kind of sideways as well. I generally speaking think that we're kind of in a neutral environment from a risk appetite perspective instead of full-blown risk on, but it's not like, we have risk off is shouting. You can see similar indications here. This is government-backed 1 to 3 year treasuries, versus the XLK tech sector, still holding up in this bullish consolidation. We'll put a check mark. As we take a look at utilities versus tech, you can see, and we've been talking about this, retest of the trend line needed to yield a higher low. We're well on our way, potentially looking something like this. That, of course, leans a little bit more bullish. We could maybe mix that with a neutrality signal there. Obviously, XLY speaks for itself. This, of course, gets a big bullish check mark. And over here in semiconductors versus healthcare, we did go on to print a new higher high on the Friday session. So this chart probably leans a little bit more risk on as opposed to neutral or even risk off. If we're looking at emerging markets, still all set here over the 44 handle. No issues on that pullback after the China stimulus. Let's take a look now at we could look at the NASDAQ versus small cap. Sure, why not? We're continuing to push higher here, more indicative of a stronger trend in the S&P or generally risk on equities down below versus, IWM being seen as like a quick profit take, if you will, or some sort of trade rather than an investment. The dollar, this is, okay, so now let's start talking fundamentals. There's almost like two modalities to this market right now, which is kind of comical, but it just is what it is. I mean, the dollar has absolutely ripped in the upward direction towards the top end of this balance range. I would consider it a little bit technical here over the breakout zone at 101.75. No regard for resistance, really, at 104, sort of closed well above on the Wednesday session, pulled back above and moved higher on Friday. I mean, again, just like really, really strong dollar here has to be tightening financial conditions, and we can continue to have this discussion. I think it's worth talking about. We'll take a look at gold because it's related to the dollar first and then interest rates, but gold, the conversation we want to have here at least is just the fact that on the relative ratio, gold relative to the S&P, this breakout probably says a little bit more defensive posture than anything else, which is at odds with the analysis we just conducted on the S&P 500, right? So this probably leans a little bit more inflationary. When we look at the sectors and saying things like discretionary, semiconductors, and tech are doing just fine, if we're thinking about inflationary themes over there, well, paper assets will inflate as well. Is it possible that the tech sector continues to rally in the upward direction as maybe a wave 2 of inflation takes place? Yeah, it's totally possible. So this inflationary signal here does not necessarily detract from what I would say is going to be this huge nonsense crash in the S&P 500. It's worth making note that this is not, typically a bullish indication, but if it's truly a wave 2 inflation, we'll see if paper assets ultimately inflate as well. Let's get on over to interest rates now, though, and have this conversation because, again, this is something that needs to be sort of top of mind as we're moving through earnings season specifically. With the TNX aggressively rotating in the upward direction, once again, it would sort of signal that investors maybe are fearful of wave 2 inflation, but also this should reduce, in theory, higher interest rates will reduce the profitability and therefore the multiple that's applied to the S&P 500. So this is not, I would not consider this a breakout, but let's go to a weekly chart here. If this trend line breaks, 1, 2, 3, 4, 5 tests coming in here at 4.3, which is the key level from this acceleration as well as this acceleration, if this breaks in the upward direction, is there a path to 5.5% interest rates? The answer is absolutely, right? Let's continuously go through this exercise because the fundamentals here are very interesting as we come into number one, the election, at least in terms of financial policy and interest rates and what's going on with the Fed, the labor report this week, but also earnings and the earnings multiple that we're continuing to talk about. So understand that the TNX could break out. Just from a very technical perspective, is there a path to 5%? Absolutely. Pure play based on a break of resistance trendline and a break of strong resistance horizontally. That's, again, purely technical based. When it comes into the fundamentals, we can drop in here let's go to the 10-2 curve. Where is the 10-2 curve, Matt? Here it is towards the top or midpoint of that list. When the curve typically reverts back to a positive territory, right, uninversion, if you will, typically, where does it go? Well, in this instance, let's just use the 2 as the round number, right? It went back to 2 here, went back to 2 here, it went back to 2 here. You know, it stayed hovering around 2 here. This never went negative, but it did move back up towards 2. So let's take 2%, that's the differential between the two rates, right? And add that to the 2-year forecast from the Fed, right? So as we come on over here to the Fed tracker tool, we will just take a brief glance. What is the terminal rate? So let's just use the low end of the expectation, right? 350. So 3.5 plus 2, not to insult anybody's elementary intelligence, you get 5.5%. There I go, getting the number wrong. Classic. So 5.5% on the 10-year seems reasonable if that's the expectation priced in by the 2-year, as well as what we just saw from a technical perspective breaking out over the trend line. You can see here that these odds are still leaning heavily towards a 25 basis point rate cut for the next meeting. I would tend to think, depending on the labor situation this week, these odds shift here. Probably not towards a 50 basis point cut. The 10-year yield rotating in the upward direction after the market had or I shouldn't say the market, but the Fed had cut rates is a pure play signal that the market got way ahead of itself with the Goldilocks situation pricing in I think it was 150 basis points worth of cuts by the end of the year, right? So that's just not going to happen at this point. So therefore, I do believe that odds would shift closer to a pause, not a double cut again over here. If mark my words, and this again is a little bit more subjective than objective, but I think that this would be the biggest policy mistake of Jerome Powell if he cuts another 50 basis points. I think that so far we've been kind of okay. I think that the higher for longer was okay. I gave Jerome Powell some credit for sort of going against everybody who was like, cut rates. Elizabeth Warren notoriously oh my God, you're strangling everybody, right? No, chill out, right? I give him credit for that, but if he goes 50 basis points this upcoming meeting in November, big policy mistake. I sort of take back all of the kudos I ever gave him in the first place. Let's take a look at the economic calendar here. There's not much that happened last week other than a big rotation down out of the unemployment claims here, which is noteworthy because we know that this primarily spiked due to the weather situation we saw in the southeast region of the states, right? So this is like Hurricane Helen and, of course, Milton that sort of ravaged Florida a little bit there, and the longshoremen strike. And we talked about this in the stream, right? You have unions paying those benefits, but generally, there's the longshoremen strike, Boeing strike here. So this is coming down aggressively back to some pretty comfortable reads that we had been with prior. So this upcoming week, as I'm thinking about the labor report, I want to see how much, or if at all, the big spike sticks in the reading. If it doesn't show up at all and we just see the status quo, stable unemployment read, I really think, again, that the odds should favor more of a pause from the Fed, which will, technically tighten financial conditions, pressuring markets, I would say. That's sort of the take. That's the ultimate bottom line for the markets, right? But anything that's aggressive from the Fed in terms of 50 basis points of cuts seems irresponsible. Looking forward to this week, here are the key dates and times that you need to pay attention to. Tuesday, October 29th, JOLTS. Job openings 10 o'clock in the morning. We'll be watching out for that. Wednesday, 8:15 pre-market. We will be live in pre-market prep at that point, but ADP non-farm preview. Advanced GDP is going to come out here for Wednesday at 8:30 as well, so pre-market, but not really paying attention to that this week. It's more about the labor report. Core PCE is not going to move the needle on the heels of CPI prior. ECI will be important, maybe just from a inflationary perspective, Unemployment claims, as always, this is a weekly thing that we're monitoring. Notice the uptick here in the forecast, kind of noteworthy. And then Friday is the full Monty, right? So on Friday at 8:30, hourly earnings, NFP, the full report from the government survey, and then the true unemployment rate month over month. If this stays down here at 4.1, even if it goes back up, right? Because if we look back here, we know that this read was a 4.2. We know that this read was a 4.3. If we're anywhere under 4.3, there's no world in which the Fed should be even considering another double cut in the November meeting. That's just my personal take. I don't think they've made enough progress on inflation, as we've continued to reinforce over a number of episodes now. Here's the earnings calendar. It is jam-packed. So once again, prepare for volatility this week. We sort sort of went through a lot of the key levels on the market, but those levels may or may not be in play if these stocks start gapping up big time, if the news reports, the economic data in the morning starts causing large gap ups. I'd say things really start to kick off here on Tuesday after the close. Of course, here are your honorable mentions, not even Snapchat. Let's get them out of there. Let's talk about Visa, which will move the needle for the financial sector. Then your secondary honorable mentions are here. The world's most expensive burrito, which after the 50-1 split is really not that bad anymore. Before the open on Wednesday, honorable mention to Eli Lilly for the healthcare sector, honorable mention Caterpillar, but really, here are your heavy hitters Wednesday after the close. You could get your popcorn out for Coinbase, Robinhood, maybe Roku. It's been an okay trader, Roku, in the past, so we'll see if it comes back from the dead for earnings. Again, on Thursday, some honorable mentions, but nothing that's going to move the needle all that much, other than maybe MasterCard. I think that MasterCard's likely to make a sympathy move to Visa, so you're probably not going to get all that much of a different impact on Thursday morning. And then, of course, here, after the close on Thursday, another round of heavy hitters, Amazon and Apple, honorable mentions to Intel, and that's really it for the end of the week. Chevron, kind of interesting. You'll see why, not only because of what we talked about in the CL analysis, but there's a possible trade idea there that might be one of the two. With that, let's look at what happened last week with the earnings report. Generally, the update here from the PE ratio at the sector level is something that I want to read into, right? We're talking about this multiple contraction as the 10-year rate continues to move in the upward direction. It seems reasonable for the Infotech, the XLK, of course, to see a contraction of that multiple. You're trading over the 5 and 10-year averages at this point at a 29.4 versus a 24.9 and a 21 on the 10-year average. Where I do think that things could be sort of caught up, if you will, is over here in communication services, because generally speaking, you're going to get Google reporting sort of in that sector, right? And that's going to sort of, in my opinion, push this, I think the forward PE up a little bit, so over some of these averages. And if that takes place, it might balance out any or some of the contraction we maybe see out of Infotech. It's not quite as strong, or in terms of weighting, as the tech sector, of course. The other one is possibly over here out of consumer discretionary with Amazon on Thursday. Note, if this starts to push higher as this contracts a little bit, that might be something, just generally speaking, worth making note. And again, this is all based on the fact that 10-year rates are moving higher. It wouldn't be unreasonable for this to just sort of catch up to maybe its longer-term averages here, and this to sort of compress to its longer-term averages over here as well. With that, we will move along into, let's go back on over to the platform and start taking a look through some of the risk appetite charts. Here we go with the TLT ratio to the S&P is still in the gutter. No issues over here. Really, it's the bond chart that we want to pay attention to, which I was alluding to earlier. This, of course, is representative of investors on the bond side, at least looking for a higher yield, and higher yield has absolutely been taking place in some of the shorter term bonds right now. Of course, you're getting that uptick on this sort of rebound off of what Jerome Powell had seemingly done, which, we're going to cut rates, but it was already priced into perfection, so moving back in the upward direction there. This really doesn't speak to a strong risk appetite in equities listed down below. As we take a look at credit spreads, we're also starting to see some emergent issues over here. Nothing where I would start raising the alarm bell and saying, oh my goodness, it's the end of the world, but an uptick and an uptick, which are both holding so far. You didn't really see aggressive breaks down back towards the lows into the end of the week on the gap up from Friday. If we look at junk bonds by themselves, you're still massively divergent over here. Note the big time lower highs that continuously get put in versus sort of the equal highs, intraday at least, on the S&P 500. And you can still swap out the LQD corporate grade bonds, which are even worse. Look at the slope of this downward sort of lower high that happened on Friday versus what's happening in equities. So this is still somewhat skeptical of the sort of continued sideways consolidation over here, and is probably a data point that the bears would want to lean into quite a bit. If we look at Bitcoin, it is starting to pull back but break above. Do something like that. So it broke above last week, and now it's pulling back for a retest over the trend line. I think that this is still in play for higher. I'm not overly concerned about this signal here from a general risk reward perspective, and we had been talking about this even in last week's episode. I think that there's plenty of room to run towards that 110 on the cup and handle measured move, right? Something that looks like this. The scale is skewed because it's a log scale. I think it actually broke. Yeah, it broke actually back here towards a linear scale. So you can just see how the risk reward, generally speaking, is about a 2-to-1, 3-to-1, probably closer to 2.5 to 3-to-1 risk reward ratio here. If you were to put a stop all the way under the lows of this consolidation. So still offering possible entries here. Again, I'm not advocating that you do any particular thing with Bitcoin, but this is the range that I'm looking at, and I have certainly started to trade myself. Let's take a look at the breadth of the market, which had contracted this week, reasonable, on the big sort of push to the downside on Wednesday. Notice that the 50 SMA moving average, that's the blue line, has moved more aggressively than the 200. So is it an outright, oh my God, danger situation? No. If you look at what happened back here, let me just make these charts back equal to one another, or at least zoom them in equivalent. Let's do something like that, and then something like, where are we going here? Where are we going? Let's auto zoom the lower one perhaps and try that one more time. Thanks again for bearing with me as we update these charts in real time. The illustration I'm trying to make is that when the 50 SMA aggressively came underneath the 50% mark, but the 200 SMA in green went more so sideways, it was really just a weekly pullback before continuation than anything more aggressive. And you can even see that over here as we were sort of playing catch up. It dipped back down as this remained elevated and sideways in green, and then we sort of see the market catch back up. So if the 50 SMA pulls back, but the green 200 can stay sideways, not the end of the world. And generally speaking, what will confirm this is the lack of new lows versus new highs, right? If you just invert that, right? This is new highs versus lows. When it goes negative, you have more new lows than highs, obviously. So as long as we're over the zero line here, still not overly concerned with breadth. It looks like a mild pullback until proven otherwise based on this chart in front of us. I think that's an important call out. If we look at the RSP, we are technically underneath this level. So again, is it possible for a weekly pullback? The answer seems like yes. You're over that level here in the S&P versus the equal weight. It seems like it's possible that the market is a little bit cautious as we're headed into earnings season, right? Let's move along into the equal weight NASDAQ. It's basically a rinse and repeat. Equal weight still kind of over its key level. Even the non-weighted, right, the weighted is still doing okay. And we talked about the relative strength on the NASDAQ side anyhow, so that's still checking out. The Dow Jones is faking us out still a little bit in this fake break there, but trying to catch for support. I'd still make the argument that, it's still trying for these constructive higher lows. And now let's get into the talk of the town, which was from the intro, volatility, right? The VIX might not look like it's doing much here into 2050, but generally speaking, understand that this is well elevated over the consistent low reads we had seen underneath 15 for a very long period in 2024. So is it possible that this starts to get a move in the upward direction? Sure thing, especially when we start looking at precursors such as the VVIX, volatility of volatility, starting to push back higher. You have not technically gotten that breakout over 120, but that certainly seems like it could be underway with the strong move higher into the end of the week, and especially here as well with volatility futures. And this is even outside of actually Z and X. Yeah, you're pricing in the election still here in this volatility contract pairing, but stronger backwardation. Look at even just the 9 versus 30 day, stronger move to the downside, getting closer to backwardation, but still in contango. And then you have over here on the 1 day, look at the acceleration. So the liquidation break stays underneath that 1275, but the pullback from the high of day on Friday closes over 1275, any continued acceptance up here. And again, I think that volatility sort of takes a grip on the market as we come into earnings season, election week, the labor report, the Fed meeting. I think it's kind of sort of a perfect storm of volatility, and we'll see if we can get a market to pull back. And again, the big trigger, I just want to be very, very, very clear about this, right? The technical trigger always needs to happen in alignment with the signals. If the market's giving us volatility signals and oh my goodness, the breadth is contracting and junk bonds are sort of massively divergent, but if the broad market is just doing this, probably not loading the boat short. If we do something that looks like this, I will change my tone, I will participate in downside, but until then, you could get any number of bearish signals. There's only one thing that pays. You guys know the saying, price pays. Let's take a look now through the core list of companies. Then I've got 2 trade ideas to share with you, and you're on your way for the weekend. Let's see what's going on with Apple. Daily chart, I've seen better. I think that the thing that we want to maybe focus on here is the possibility for a lower high underneath the breakout point 233. You still have lows, higher lows, maybe higher lows here, but the Friday upper wick becomes a little bit concerning. Notice how precise this level is in the market, this 233 level. Very, very precise, exact rejection from Friday as we take it on down to the hourly time frame chart. I think that you're caught between a rock and a hard place in here. This is where I want to participate long. This is where I want to start thinking about where's the short entry, probably something that looks like this for a deeper pullback to 223.75 over time. Really coming from, this is what you need. That's the magic key for Apple. It's a lower high underneath 229.50. Break this down as like a bear flag, if you will. If you get underneath, I think the door is open. If you're just consolidating up here, it's a rock in a hard place, and this is the only time I would re-entertain longs, is a clear higher low hold above 233. Apple earnings on Friday. Keep that in mind for everything we're about to talk about on the earnings front. Let me quickly fire up this study over here in particular. Let me bring this up, and we want to use just that one study. It's going to be a lower study for implied volatility rank, and I want to give you the disclaimer once and once only. Apple's not really a great example because typically the IV is very low here, standard. But if you're swing trading options through any earnings announcement, you have two factors fighting against you. This is my argument personally as to why I do not hold short-dated contracts through earnings. Number one is that you, of course, have very classic theta. Time is against you when you're trading short-dated options. It's when theta decay is the most aggressive. But more importantly is that number two is implied volatility. Implied volatility after earnings typically crashes. This is a very extreme example out of Apple back here, but even this time around, this is enough to take a substantial chunk of the extrinsic value out of your options contract, not a force I want to fight. So, with a 50-50 coin toss on whether or not you get a gap up or a gap down out of earnings, because remember, you could get really strong numbers, but they miss the expectation, you get a gap down. You could get really weak numbers, but they're better than the expectation, you get a gap up. It's a 50-50 coin toss, in my opinion, unless you've done all of the diligence that you think you should do. And even then, it's sort of, you've got a mixed bag of odds. This is not enough. I will not take options contracts with two things working against me on a 50-50 coin toss. The odds just do not make sense. If you're a risk manager at heart, the only reason or the only way that you can trade that is if you're trying to capture the theta and the implied volatility by being net short options, or if you have your positions quite literally sized for zero, you take a little bit of a, think of it like a lottery ticket. If it goes and it works out, great. If it goes to zero, it's not going to hurt, right? So that is the earnings spiel once for all of the earnings candidates that we have on the charts in front of us today. Next up is Microsoft. Again, earnings on Thursday, Tuesday, Wednesday, one of the days. You can go back and reference the calendar. Notice that implied volatility actually is higher here than what it was in Apple, 70 versus 50, so keep that in mind if you're trying to trade it. Again, nasty bars on Friday. This is not a shocker here, but where are we? We're back over 425.25, so I have to give credit where credit is due. Ding, 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 this from back here. If we can stay above it, maybe a little bit of a push in the upward direction towards this pivot high on the daily, 440.65 becomes a target. Let's go to the hourly, see if we can spot the setup that maybe makes that unfold. I'd love to see a full gap close, support off of 425.25, retarget the highs, then break out of this as a bull flag to get into that sort of zone we just talked about. So the bullish setup is there on a hold of 425.25, looking for upside over time. You could probably Brigade bolt it again over 432.15. In here, not really interested. I don't even think I would be... It's tough because, there's probably some development that happens where maybe there's a new short trade in this area as the week passes on, but we'll have to update that in real time. Based on the current look of the chart, I really would not want to be a new money short here, simply noting the daily 50 and 200. Maybe there becomes a short under this 419.75, but one step at a time if you're trying to short Microsoft. It would be my opinion here on the hourly at least. Let's move on over to NVIDIA. NVIDIA does not have earnings coming up, but the IV is still hanging out around 42. Relatively cheap, I would say, actually, for NVIDIA, noting some of its other runs back here. IV was like, 90, 80, very, very elevated. So with that, you are getting a lot of rinse and repeat like everything else. Looks like a nasty daily Friday bar, but if you go on down to the hourly time frame chart, NVIDIA actually looks great here for lows, higher lows are holding. Equal high was produced. If you get an hourly higher low over this range right here, I know it's kind of sloppy around it on Friday, but if you can hold this 141.50 and rotate back to the highs, just call it for what it is. Let's not overcomplicate this stuff. It's just an ascending triangle. It's the possibility of an equal high breakout. Where does that bring us? Blue sky territory. So watching that very closely here out of NVIDIA. Can we find buyers here, and can we rotate back up to the highs for blue skies? If we rotate back below, then yeah, any lower high that's here sets up the oh-so-classic Man Ray pattern. Here is your little double top. Right shoulder, under the neckline, kiss it goodbye. That would be 136.50. That would have to develop over time with the proper structure. There's an argument to be made for the bearish setup when and if it actually unfolds. Until proven otherwise, it is bullish here on NVIDIA. Google earnings this week. What do we see? Implied volatility looks like it's hanging out at a 68. So there you have it. Keep that in mind. Google is still just nothing more than a balance range in here. It is getting a little bit more attractive to trade for a potential breakout over these highs, noting if we go on down to the hourly. So actually, sorry, I'm getting a little aggressive with the speed. Let's slow it down. If this can hold as a right shoulder in general, I'm still bullish on the daily time frame chart, looking for the neckline break over 169 to close this gap over time. That's the really high time frame story that's trying to emerge here. On the hourly chart, what I'm trying to bring up on that sort of aggressive approach that I was just taking is that this is building out more of a structured balance instead of back here where you're just chopping and slopping back and forth through that level, to the point where I would probably entertain long trades for something that looks like this. If we can higher low Brigade bolt over 165.50 intraday ahead of or post earnings, probably worth trading into 169. Earnings here looks like they are Tuesday after the close, so this trade would have to unfold on Monday or Wednesday, sort of like midday after some of the earnings volatility has, left the options pricing, right? So 165.50, kind of a key watch there. And of course, earnings could easily gap this up, gap this down. So take all of these levels with a grain of salt also if the company's reporting earnings. Things can change rapidly, right? And we'll have to do a reevaluation. Amazon, very classic, just balance range. Let's actually go to the daily chart, check in on the IV, about 71 on the implied volatility. And by the way, if you want this study, I think it's free on the site. You can just go to tradebrigade.co/trading-scripts, and this is called Implied Volatility Rank. You can find it towards the bottom of the lineup, I believe, for free. So with that, what do we see out of Amazon's daily? It's trying to build a block here after a nasty undercut from Wednesday. So kind of neutral until proven otherwise out of Amazon. Here it is on that hourly balance range, just sort of in the midpoint. I'd say that's more similar to what were we saying out of IWM, small caps, right? When things become like clear and obvious, it's just this out of Amazon. So you need 186.25 or 189.50, 190.50 as a bit of a zone there. Anything sideways in the midpoint, leaves a little bit to be desired, especially if earnings are going to impact the implied volatility and options pricing. Let's move on over to the metaverse. Kind of another slightly disappointing chart with the way it traded recently, but notice that the implied volatility is actually much higher here at 85, so keep that in mind on your options. They will be quite premium rich with extrinsic value. This is sort of a lower, like daily read is inverted hammer, lower high rejection of this balance range closed underneath. Hourly read is like, well, if this is going to turn into one of these guys, it's very possible that not closing the gap all the way and getting price acceptance over 574 just yields a move back to the neckline. You could take that approach, but I think the more confident approach would just be like clearing the neckline at 584, right? So let the consolidation build out, let it do its thing, and then this is probably the trade that you wait for patiently, right? So some patience might be required here on Meta, once again, an earnings candidate. Keep that in mind. Tesla. Earnings in the rearview mirror, so options is cleared for takeoff. Let's just quickly check in. Did we have an example here? Is there a learning lesson? A little bit of an IV crush, but nothing major. It could continue this week if this, once earnings sort of all flatten out from all of the companies here, we'll see how that continues to progress. But generally, it's straight up move in the upward direction. Maybe that's why the IV is still elevated, because the volatility intraday has been quite large in terms of upside. But you got this big island reversal. So Tesla, the talk of the town on Tesla is the island reversal from the technical perspective, where anybody who's short from down here is absolutely burnt on the position. And then also anybody who's long feels like, $1 million off of that. There's probably no reason to stop out, even if you come into the gap, something that looks like this. So generally, bullish story here. I think the daily chart really speaks for itself. We have some upper levels. You can just write these down if you're interested in charting them out. You can look left, but 279.75, 296.50, and 312 are your next overhead levels out of Tesla. From a weekly perspective, just understand that you're breaking out through this flat top after lows. Previous lows were even lower, but higher low island reversal we just talked about, through that on the weekly or even the monthly, starts to probably get Tesla moving in the upward direction. So I'm not calling for all of these targets this upcoming week, but it's not within, or I should say it is within striking distance that over the span of the next couple of weeks or a couple of months, we do see a grind in the to the upside. So hourly chart here, let's get those axes acting right. There we go. Just nothing bearish to say. How could you say anything bearish here? Upper consolidation over the highs on Friday, day 2 continuation. I think if you're long up here, you're sort of getting a little bit long with poor location. It would be great if this could consolidate out or pull back and hold over 250 and then really go for that weekly break we were just talking about. If the balloon does start to float away, just understand that this would be the next best entry over here. Tesla over 266.30 on a more aggressive pullback if it continues and then goes, right? So Tesla, It's got to be bullish. It's just a matter of spotting the risk-friendly long entry in the upward direction. Next up, JP Morgan. Financial earnings are in the rearview mirror, so no need to check on the IV, but generally just a daily bull flag. Couldn't really make it happen on the Friday session, so patience here out of JP Morgan, more so consolidation, looking for the Brigade bull over time. If it does pull back, daily higher lows are well and fine, over 215.75. Netflix can't really flip into a mind of its own just yet, but do understand that generally this took a couple of days post earnings and then resolved. Took a couple of, actually more like a couple of weeks post earnings and then resolved. So it's very possible that you just build out consolidation and then go for it. But let's just go to the hourly to keep it simple. If you're underneath this 760.50, I think that a pullback all the way to test the top of the earnings gap is very reasonable, 736. If you do get acceptance up here, I would just, pure play the levels and look for the higher lows over 767.50, 772, unlocks blue sky territories. I'm probably not interested in like shorting this into the gap top, but if it does find a move that looks like this and then starts to Brigade bolt lower high under 736, that to me is maybe where I'd participate to the downside, only if earnings continue to come in poorly from other companies. And Netflix sort of like, it has its little mind of its own in the first stage and then sort of drifts away and plays nicely if other earnings come in poorly. Again, asterisk and emphasis on the word if there. Next up is AMD earnings on Tuesday to kick us off sort of after the close. How's the IV over here? Looking at a 62, not nearly as bad as some of the other names we've seen so far. Apple a little bit lower though. So AMD daily chart looks very classic to me. I mean, AMD has been trading like a knockoff NVIDIA. You could actually probably argue that is the case, but AMD has been trading like a knockoff NVIDIA, not even close to the all-time highs, finding acceptance underneath this pivot back here. Big, nasty inverted hammer like everything else. Let's go on down to the hourly. The only thing you could argue for here is like a longer-term left head, right shoulder maybe builds out over time on acceptance over 153.50. I think just waiting for post earnings is probably what we're looking for out of this name on Friday. Nice little opportunity off the micro inverted head and shoulders, but as of right now, not much to really say in the midpoint of this consolidation after you've already hit the top end of the target for the look below and fail if you wanted to consider it that in the first place. So AMD is on ice until post earnings. We'll update you on Wednesday with the midweek market update. First trade idea is, as we've mentioned, on CVX, which of course is Chevron. The reason that I wanted to talk about this, earnings are on Friday before the open, so keep that in mind. Let's remove that implied volatility rank. If this can happen pre-earnings, which I think it very easily could, then we're looking for a break of the flat top at 152.50 over the daily 200 SMA. Look left, thin structure retracement. You could call this left, you could call this head, you could call this right shoulder. Generally speaking, I think the outcome here is a long through the thin structure with the geopolitical tensions all the way into 158.65 as a potential target, and that would be your upside move. Measured move, as in a range double, certainly comes a little bit shy of that, so maybe watching the 157.50 flat top break. I think it's a very, very well-defined level of interest. I think that we have a catalyst in play to make it happen. If you can break out of this balance, I think we're looking for upside. So probably overcomplicated the explanation of a very simple trade, but there it is. Next up, we have AXP, American Express. They just reported earnings, so that's not really an issue for us over here. But what's the classic daily pattern? So I gave you one long, and I've got one short for you as well. Left, head, right shoulder, back down at this flat bottom neckline, 266.50. If you can break it, which is very well defined, we'll look on the hourly. I just think that this prior pivot is an easy target back here. I do want to reinforce that American Express is in a very, very clear weekly uptrend. This could just be a weekly pullback and then look for continuation in the upward direction. But as a scalp early on in the week, absolutely, all these equal lows, 266.50, Brigade bolt below, you're looking at 261, right? Support from back here, resistance and resistance, that would act as your target. You could say, Matt, I want to go counter to your move. I think that, yeah, you might be right about the pullback, but I actually want to go long here. If we can hold this daily 50 SMA and Brigade bolt back up and over 266.50, even better. Undercut, look below and fail, rotate back up to the highs. Be my guest, but those are the technical levels that I'm watching here out of AXP. Very interested in 266.50 early on in the week. That is going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. I did try to solicit some feedback in last week's episode as well, so I'll do that once again. Let me know, do you guys wish that there was a different segment in the video? I feel like we've been very consistent with the format here, and I like the technicals that we, of course, always look at. But if there's something new we can shake the show up with, if there's some new thing of interest that will be of value to you guys and even help my own analysis, let me know in the comments down below. Quick reminder, the show will be kicking off the pre-market prep. Show will be kicking off on Monday at 8 o'clock Eastern time, but I will be on the West Coast, so apologies in advance if I have a groggy voice or if there are any technical difficulties on the Monday morning stream. We'll see if we can iron out any of the kinks ahead of time, and I look forward to seeing you in the show from a remote penthouse location. With that said, have a green trading week, and I will see you in the next one.